welcome to all those streaming live from across the world. Today is going to be, yesterday was What's the Deal with Deals, all different aspects, and today is going to be Deal Maker University. And again, this is going to be learning from insiders. It's going to be what's really going on in the middle market, tips on how to do better, and information you can't get because it's like private markets. But we have a great first panel. This is going to be on insights from people that run companies and CEOs. And I'm going to turn it over to, from HMB, Sean Auton.
Tom, thank you very much. And he stole my pen. Oh my God, I can't believe that. I'm just kidding. Hey everyone, welcome. Great to see you guys. And really excited today. We have a fantastic panel to start off, so hopefully we get some good energy going. I can tell everyone enjoyed last night quite a bit, so that's fantastic to see. And hopefully at home you enjoyed it quite a bit too. So the first course today, we're going to talk about navigating economic uncertainty. And what was fascinating in the prep work as we were talking about what we wanted to chat about today was there's even uncertainty if there's economic uncertainty. So this is going to be a fun conversation. And so we're going to start off, I'm going to let the panel introduce themselves and talk a little bit about their business so you understand the perspective that they're giving their advice and giving their experience share. So why don't we just go down, Jonathan, we'll start with you.
Sure, I can start. Thanks, Sean. Good to be with everybody. My name is Jonathan Carson. I'm co-CEO of a company called Stretto, which is the largest technology company in the bankruptcy ecosystem. We run a handful of businesses from the corporate restructuring side all the way over to the consumer bankruptcy side, based in Los Angeles, known Aaron since the 4th grade, and I'm super happy to be here.
Hi, I'm Suzanne Yoon. I'm the founder and CEO of a lower middle market private equity firm headquartered out of Chicago. It's Kinsey Capital Partners. And we are focused on controlled private equity in the lower middle market, which we define as sub 15 million of cash flow EBITDA. That's not always, and not necessarily restructurings, but that's really our target areas: manufacturing, business services, and consumer. And so we have we're currently investing out of our second fund and have about a little over 250 million under management.
Good morning, I'm Jeff Caney, and I'm the founder and CEO of Caney Aerospace. Hard to believe with a name like that. We
Tastefully named.
Right, it's tastefully named. We're an aerospace, defense, and medical device company that's vertically integrated. We do our own engineering, manufacturing, test services, wiring, as vertically integrated as we possibly can be. Up until about 5 years ago, we even made we printed our own circuit boards that went in our devices. So our devices are mainly motion control or electrical actuators that move things like flight controls or utility doors on helicopters, airplanes, fighters, and spacecraft. And we leverage that technology across the board into the Defense Department and into medical devices like dental drills and automatic CPR machines.
Excellent.
Hopefully, I will never meet you guys professionally. It's fun to meet you here.
Thank you very much, Jeff. So one thing I neglected to mention, this is designed to be an interactive discussion. So if you have questions, don't be shy, raise your hand, I'll call out. Hopefully we can hear you. If not, I'll do my best Phil Donahue impression and come with a microphone so you can ask your questions. So with that, let's go into the first set of questions is, let's talk about a crystal ball. What do you guys see generally for the economy from your perspective, and then specifically for your industry and your companies? So we started left to right, we'll go right to left this time. So Jeff?
Yes, we definitely, we see, well, it started in COVID. We were in the aerospace world and the medical device world. The good news about it is it's a very long lead time, and people don't tend to cancel our products because we work in highly regulated environments like the FAA and the medical devices, right? So that's good for going into a recession also, but we definitely see it coming. A couple of things that we did is, as an entrepreneur, as a bootstrap company, we never had cash in the bank because all cash would be used to grow the company. And thankfully, we took advantage of the PPP and we rat-holed that away in a special account, like a lockbox, and just invested in bonds, and because we saw this coming. No, not like everybody else saw it coming. And 2008 was pretty bad, but for us, the 2008 hit us in 2011. Again, that long lead time, so it didn't catch up with us. So that was my takeaway, is that for some industries, they're going to be hit overnight. Some industries like mine could be hit 2 years down the road. So that's something that we want to be very aware of.
Okay, thank you. Suzanne?
So I think we all kind of look toward the past to look at the future. I think 2020, I think no one knew what to expect. We thought we were kind of stabling out, I think, in 2021, and then 2022 hit, and it was a lot of surprises. I think most people in my industry, in the private equity industry, would all tell you at the end of 22, we were really glad that 22 was over, not because, we're looking forward to a recession, but I think looking forward to not having as many surprises. So supply chain issues, not being able to control that, the geopolitical issues that really created that, the Ukraine war. I think, unfortunately, it looks like that is going to be a long-term war. But at the time, it was very much nobody just knew it was coming, right? So we all had to adjust really quickly. I think for 2023, for us, looking at all of our portfolio companies, and we have companies actually in aerospace and defense, consumer manufacturing, consumer products distribution, and construction and lighting controls, and really tech, and some tech-forward companies. But I think across the board, what we're really concerned about, and what everyone really needs to be concerned about, is margin compression, and how we're going to address margin compression with increasing interest rates. But I think the good news is we are all expecting the same thing going forward. And candidly, a lot of the noise or companies that we were all probably questioning, didn't know what was happening. And this is, going again back to, I would even go back to like the late 90s. We see it in every cycle. But when companies are not well run, it shows up really fast in a recession. And growth hides a lot of problems. And we saw a lot of growth really fast, even if you either lost or you won during COVID. But we saw some really high growth companies, from COVID that are now stabilizing, but the management isn't exactly or professionalized. So there's just, in my mind, I think there's a ton of opportunity from my perspective, having a lot of dry capital. Going into 2023, I think it's going to be a great vintage year for private equity. I think it's also going to be a great vintage year for venture if you're able to buy secondaries and get in. But I don't think, unfortunately, 22 is probably not going to be a great vintage year, because the early 22 people we saw multiples peak to a point that just made absolutely no sense to us. So I think there's a lot to consider going into 2023, but for restructuring professionals, I'm sure you're all chomping at the bit here.
Excellent. Thank you, Suzanne.
Great. It's great to hear interesting feedback from kind of two different businesses. So I'm a bankruptcy person for the last 25 years. Since I began my clerkship with a judge in 1997, I've been in bankruptcy and insolvency in some way or another. And so maybe I'll take the lens of what we see operating a business in that space today. The corporate restructuring market has gotten busier for us in the last 6 months. Not incredibly busy, and what we hear from around the space is in the super big cap space, it's not nearly that busy yet. In the middle market, it's busier, and that's increasing at a more rapid pace right now. Still, 2022, 21, you saw around 4,000 Chapter 11 cases filed in this country. About 100 of them are big enough to use a claims agent firm like us. And, we still filed 35 cases last year, but back in the 09 era, you're looking at 250 plus in terms of the cases that are in that space. And so there's a lot of room to go. And I think most folks that operate in that space are seeing kind of a rising tide come the next 6 to 12 months. We also operate the largest business in the consumer bankruptcy space by way of software, which most of you probably wouldn't care about, except for maybe the macro implication. It's a software company called Best Case. 90% of all bankruptcy cases are filed with Best Case. about 12,000 lawyers around the country use it. So we have a really good gauge of what's happening in the consumer market when it comes to consumer bankruptcy. Filings are down 60, 70% from pre-COVID numbers, and there's a lot of glut in that system about to come back through. We've seen increases the last 4 months straight, and we imagine that from the American consumer's perspective, 23 is going to be much, much harder, and we'll see defaults pick up in a pretty significant way. That's kind of two different bankruptcy points of view.
I actually just picking up kind of on some of the comments you made. The one issue that is always consistent, when we go into recessions is that when the credit markets tighten up, that's also, if a company is not well capitalized, can cause a lot of problems. So I think that's why you're probably seeing, more issues in the middle market right now relative to, large, public companies. Although I think they will show, we've seen a lot of compression, obviously, in the public markets, and that's probably kind of feeding itself through this year. I think the middle market, depending on how the credit markets react, and we are seeing pressure. I mean, our valuation multiples are usually driven by a lot of times by leverage and how much leverage we can get, and which is obviously the whole tenet of leverage buyouts. And we are seeing multiples come down half a turn. It's not crazy because I think in our space, in the lower middle market, our leverage multiples tend to be smaller to start. But in that upper middle market where you're talking about, 300, 200, 300 to $1 billion, $2 billion of enterprise value, leverage multiples got very high, like 10, 11, 12 times. I'm seeing those back down to like 7. And, a lot of the credit funds, and some that are more, I think, depending on the nature of how they were started and who the players are getting very aggressive on even technical defaults right now.
Right. And Jeff, I think you said you had something you wanted to add?
Again, a little bit bouncing off what you said, to complete the thought of our crystal ball as an operating company is we are self-funded. So we're looking at outside funds for the first time ever because we think we're going to go shopping in 2023 and 2024 to help move our mission of our company forward by going and picking up some other companies that may not have thought about selling before or thought that their multiple was at 15 to 20 and very difficult to buy as a smaller company. So, we think that we'll have opportunities to purchase some assets later this year and in 2024.
Okay.
It's
John.
interesting perspective in terms of you think about the leverage markets, right? And man, I wish you would have got money 2 years ago. Would have been a lot cheaper, right? And the issue you see on the front or the back side, the companies out there with 24, 25 maturities, man, pay attention to them. Refinancing debt 6 months from now into that market is not going to be what it was 2 years ago or anything close to it. And so it's really going to become a market of a lot of opportunity for those of us who play in that space.
We refinanced everything last year.
All right, there you go.
It didn't take a rocket surgeon,
Right,
as we say
right,
at work,
right.
to figure out that when money
Right.
is that cheap, it's not going to stay that way that long forever. So it was time to do it.
Excellent. Excellent. So I want to remind the audience that I did go to law school.
Yeah, what are you seeing, Sean?
Yeah. And I will call on people because I was trained at law school to call on people at random to put them on the spot. So if no one's asking questions, and Aaron Hammer knows exactly what I'm talking about, I'm going to do the old gunfighter style and point to you. Aaron.
That was recorded, no?
Thank you all.
It's on mute, so can you? No. You want to try this one? Hello? That one works.
First off, thank you all for coming and attending and enjoying. It's great to host all of you. Super awesome friends of mine, and I deeply appreciate it. Let's ask a question of our moderator, Sean.
Now you're bouncing back. See, there you go. But if I'm
Well,
the
no.
professor, he just failed for the day. So.
You run a law firm.
Yes.
Talk to us about the challenges of running a professional services firm over the last 24 months and what you see, over the next couple years. for law or professional services?
Well, that's a great question. So I'll share a little bit on our crystal ball. And as Aaron said, and he's my partner, so he knows this very well. We're a mid-sized law firm. Service industries, it was very interesting because I think like everyone, they were very concerned in March of 2020. And our firm, we stayed committed, kept everyone. Other firms did a lot of aggressive cutting, wanting to be on the leading edge. When you're in service firms, and those of you in service firms, you know your one expense that you can cut is going to be payroll. So I think some people did that early in 2020. It was a huge mistake because it wound up, services exploded in the second half of 2020. 2021 was a deal year like no one had ever seen in their lifetimes. There were multiple investment bankers that are friends of ours that for the first time in their 20, 30-year careers did not want to take on a deal. So it was insane. But it also made the job market insane. You know, lawyers in particular, salaries spiked. We have a new work environment. Remote work is some variation of it's probably here to stay. These are all challenges as we're looking at how you restructure what it means to be a service provider, where you provide services, how you provide those services. And as we continue to evolve over the next year or two, that's going to be very interesting. For a firm like ours, we look at it as a fantastic opportunity because now our market has grown where we can recruit talent from anywhere in the United States. And that wasn't true in 2019. So that's the opportunity I think we're seeing. The challenge we see is just what is the evolution of a service provider. So thanks, Aaron. I appreciate that. All right. Other questions from the group, because obviously I will call on you. There in the back.
Thank you. Hi, this question's mostly for Jeff because we had a fascinating conversation before this session started. I've been self-funded. It's a scary thing. You mentioned you were self-funded up until now or recently. Where did you zig when others zagged to get to where you are now? And what would you have changed to navigate that uncertainty?
Well, ignorance is bliss. Let's put it that way. And there were times when I sat in my office and I looked at the cash in the bank as we were a young, very, very, very young company and running out of cash and thinking, what do I do? I mean, just how am I going to make payroll next month or next week? And in those times, you just sit at your computer and you pick up the phone and start calling people, you start emailing people, and you start hustling. Whoever thought that you could go to Collins Aerospace and hustle them to get jobs from them, and it was possible. I never thought it was possible to go to some huge multi-billion-dollar publicly traded company and kind of beg for work, and I did. And it just kept working. The other key was, I will tell you the key to the success of our company is as fast as I could, before I could afford it, I hired a professional management team. And now I don't run it day to day because I don't have the skills to run it day to day. So now through YPO, I happen to go on the aircraft carrier. And one of the things I learned when MJ and I were on an aircraft carrier together, you don't get any sleep for the 24 hours. But what I really learned is going up on the bridge and I'm watching a 1 or 2 striper steering the aircraft carrier. And the captain of the ship isn't even up on the bridge. And that really taught me a lesson about leadership and about having policies, systems that need to be well entrenched, alignment, and a culture that has to be entrenched throughout the whole company. And your real job is coming up with a mission and a vision and then fostering that culture and looking for alignment every minute of every day. And then that strange thing of having that, it's the paradox of having that and then but having to be flexible so you can miss the icebergs along the way, which are always popping up.
Okay, well, hopefully not too many for the aircraft carriers. Suzanne, Jonathan, anything you'd like to add to that? Okay. Oh, go ahead, Suzanne.
Oh, I was just going to say, a lot of people don't think about this, but we do have investors in our fund, but at the management company level, in private equity, not unlike any other business, you can choose to self-fund, or you can bring in investors, and we also self-funded. It is very hard to do. But what is the benefit of that is you control your own destiny, and you own most of the company, or all of the company, right? So there's a lot of thought process, I think, for most entrepreneurs and founders. Every day, I think, where that trade-off is constantly thought about. I'm sure, Jonathan, you probably went through the same thing when you started your first company. So, this is probably a separate founder conversation, but it's definitely a struggle, like all the time. And then one day it just starts working, and you're like, oh, here we are.
It's a
'Cause I
more
worked-
fun conversation.
And by the way, it's also, and ultimately, at the end of the day, it's because you worked your ass off and you got a bunch of people to believe in your vision and go along with it. And
It's
probably
also,
smarter people than you.
well, it's also what helped Jeff get through. I mean, Eric and my first company, we had no outside capital at all. And when you've got that dynamic, it's just the two of us. We go to Vegas every December, have a 10-page agenda. What are we going to do next year? And when shit goes south and it gets hard, there's no one to call in Greenwich to say, well, what do you think? And to have someone, and this time around, we're 5 years in, and we bought this company with a very large $30 billion private equity firm. They're amazing. We've been so lucky, and as a former Caney lawyer, to have that experience. It's not what I expected, and it's been awesome. But not every experience is like that. And when you're on your own and it's just reporting to you or whoever your internal close team in, maybe it was just Jeff, it was just me and Eric. And there's something really liberating about that, and freeing, that lets you operate in a way that you know how to get from A to B.
Okay, thank you very much. So, question I want to segue into, and all of you have touched on it a little bit. 2008's cast a very long shadow on the American economy. And that certainly was a time of uncertainty, certainly a time of distress. But other than 2008, or it could be 2008, as Jeff alluded to, what is a moment that you can give an experience share of going through where you had uncertainty and what you got right, and perhaps more importantly, as an experience share, what you got wrong? And Suzanne, I'm going to start with you this time.
I think, what are we in now? Aaron, our fourth cycle? We're going into our fourth cycle. So I'm aging myself. I never thought I would see 4 cycles. And I think you take everything that you learn from all the other cycles that you've gone through, but the challenge of, and always, I think the challenge of being a leader and a CEO is that we always run into unprecedented times. I mean, these last 3 years, who knew? Who would have ever guessed a pandemic, another war, in Europe, massive geopolitical issues with China. And government policies that are really affecting our day-to-day in the U.S. And just all of these, like the conversions of all these unprecedented times. That's actually what makes being a CEO and an executive very difficult. Is you have to create the precedents in unprecedented times. It's so as I think about all the different cycles, I'd say the last 2.5 years have just like rocked my world, and also in like a good way. It's really made our team, me and my partners, focus on what can we do better, what are the processes. We're always going to develop new processes and procedures based on the challenges that we face every day, and a lot of that is moving quickly, which I think a lot of you as restructuring professionals know. One thing I would say that I have been thinking a lot about, and we do a lot of demographic studies, and so I just wanted to share something with the group. The millennial adult population is the largest adult living population in the history of the United States.
Wow.
So the baby boomer population at its peak, taxpayers were about 87 million in the U.S. Gen X was 46. We literally almost were half of that. So the recovery coming out of 2009 was primarily driven by Gen X, with a population that was half of a taxpayer population of the prior. Now, millennial population today, 91, arguably 91 to 92 million millennial adult population that is in household formation years. And we all know when you have children, you start spending money like crazy. And then a generation to follow the millennials are the Gen Z, which are probably a lot of like my children who are now teenagers. And that's going to be 94 to 95 million estimated U.S. taxpayers. So the offset is we're going into this recession, but offset by this massive population growth. And I think we should all be thinking about where are these millennials going to spend their money? Because whatever they're buying, whatever they're spending their money on, is where the B2B businesses, the manufacturing businesses are going to be focused, right, over the next 10 years. So, there's a lot to think about, but that's also new data. So you have to constantly, I think, look for new data and not always look to the past. I think there are things that we can learn, like with the FTX debacle. I mean, it literally reminds me of Enron, which I worked on in 1999. And I'm like, oh, this is like Enron all over again. So lots to learn from the past, but I also think there's, the same things show up in different ways. But there's also a lot of new things to consider.
Right. Well, first off, Suzanne, create the precedents in unprecedented times. It sounds like a TED Talk. Mark, I think you two should get together after this. Jonathan?
That's a fascinating demographic there. I'm still trying to digest it. It's really interesting. If any of you have any millennials that work for you, you know what a pain in the ass they are also. They are a very different breed of employee. And I think that's on that topic the kind of maybe the biggest challenge I would talk about. 09 was so different than now. It's different from 2000, 2001, and people can discuss that. But the leadership challenge of the last couple of years has been a very real one in terms of taking a business and having 400 employees and having to do things like inspire and manage and rally people around missions when times are very difficult. I thought Amish gave some cool comments on that yesterday, and I think that's just something, if you run a business, you have to always be focused on. It's all about the people, both on the inside and the outside, and how do you make sure you're managing your team in a way that lets you drive business forward and grow with them all behind you. And a lot has come to mind in the changing times in the last few years on that topic.
Well, Susan, after your comments, my brain's a little locked up. I'm thinking about how we can leverage aerospace into that market, but
They're all going to fly.
they're all going to fly. That's exactly right. I'll just tell you about a challenge that we had. I remember when my wife Nancy's sitting right here. We had the Last Supper just prior to COVID. When COVID, everybody's talking about it, and all of a sudden everybody's at our house and we're having this little house party. We're looking at each other like, I think this is the last time we're going to be together. And I remember that was a Thursday or Friday night. On Sunday, we went to the grocery store and everybody's walking around like this. So I go to work on Monday and I'm thinking, we all thought the same thing. What's going to happen, right? Are we all going to die? Is this going to be like one of those made-for-TV movies? Like, what is going to happen? And so I thought, again, as the leader of the company, what do we do? How do we manage this? Like, this could have been, weirdly enough, wasn't. But I was scared. I was scared to death just because it was unknown. I was just scared. So I put a one-page PowerPoint together, and it just said nuclear option, 2008, or bumpy road. And I called our team members in, and we sat in opposite corners of the conference room, my exec team, president, vice president, and CFO. And I said, we need to answer these questions. If it's as bad as how are we going to keep, if it's a nuclear option, like this is really bad, and we're going to start losing money tomorrow, how are we going to keep the lights on? What are we going to do? And we spent about 10 minutes talking about it. It was going to be huge personnel cuts. It was going to, these type of things, like really, really, really bad. And then it was like the 2008 issue that we went through. Like, if it's going to be like a 2008 issue, what are we going to do to respond to that? And then we talked about if it's just a bumpy road, what are we going to do? And it was one of the best meetings I've ever been in my entire life. And in 25 minutes, we left the room with a plan for all three of the contingencies. And then we just went to work. And we all know what happened. And to think that 2021 happened after that, the business cycle was just crazy. But that's probably an example of navigating a unknown rough water.
What about you, Sean?
So, Part of it is, I think, for us, and I'll just share our business, and 2020 I alluded to a little bit, is we looked at it, and we looked at there were going to be challenges and there were going to be opportunities. And before doing a knee-jerk reaction, being thoughtful in how you proceed was critical. And I thought the leadership team of our firm was incredibly thoughtful, because whereas payroll is the easiest cut, getting good talent is the hardest thing to do in this industry, in our particular industry. So that had to be something before we started to really kind of damage the golden goose, that needed to be a last resort nuclear option.
I was on the board.
Yes, Aaron was on the board then, so he knows very, very well. So that was understanding, having it mapped out, having the plan that Jeff alluded to is very important, but understanding what is the core part of the business. And law firms, and there are law firms in Chicago, I remember in '08, there's one firm and we hired several attorneys that came out of there, and they laid off everyone that was 5 years or less. That law firm had to merge out of existence within 2 years. So understanding the value and what is the most critical part of your business that has to be the last piece you touch, I think is very important. So we have a little bit of time. I have another question for this excellent panel, but I want to go back to the audience with any questions, because I will call on you.
Back to deals, as you're considering companies to either bring in your portfolio or to acquire, are you changing any of the ways you do due diligence?
So at our firm, I mean, we've had pretty extensive, I mean, my experience about 25 years in investing, so our due diligence processes are pretty extensive. I've always been a big believer in cash, and so I think that probably goes back to my roots in credit and following cash. So actually, it's something new, like we don't do, most private equity firms don't do deep dive cash recs. And so I think that's something that we instilled at our firm right from inception. And so that's actually served us really well, and having an entire team that's trained on thinking about cash and not just adjusted EBITDA is actually a really important factor, I think, in our due diligence. I think diligence constantly evolves. I mean, today, the level of deep dives we do on cyber relative to even 5 years ago in the industry in private equity is tremendous. And then in addition to that, now it's turning into there's additional requirements around ESG reporting, and which is also very complex. Because the SEC now regulates the private equity industry, and the SEC is getting, I would say the compliance around SEC compliance and what we have to do for ESG reporting is also getting pretty, I would say, tenuous. So we have to do a lot of diligence on that up front.
Susan, again, thank you for saying that about the amount of money that we're spending on cybersecurity is eye-watering. It's ridiculous. So you make me feel a little bit better about it, that you think that is such an important
I've
part.
had every one of my portfolio companies has had a cybersecurity issue where we've had to go, our insurance companies have had to get involved. So you should know that, yeah. It's real. So.
Yeah,
All right.
it is real.
Jonathan, anything you want to add to that?
Great comments from both of them. We spend a lot of money on a lot of different cyber and tech issues, knowing that the audits and the things that come back the other side are very intense these days, and we just can't afford not to be right, not to be on track. The other thing I would say is I'm on the other side of it, own a private equity owned business. I'm the operator. We're 5+ years in. I get a lot of phone calls, and we're in a bit of a bigger cap market than. But from those phone calls, I meet with lots of private equity people, and the comments these days have seemed to be more toward we know you guys aren't doing anything right now, but we want to follow along. What we don't want is that phone call or that email in a year or 2 or 3 years saying, hey, are you interested and we need an LOI, which we would never do. But the point is, I think people got used to some very quick diligence periods and very expedited processes, which turned out to be not so good in many respects. Mm-hmm. And now I think a lot of the investor base is looking at tracking companies longer, following along more diligently, as opposed to being brought in later if they're interested in investing. At least one of the things I'm seeing on the inbound side.
Great point. Any other questions from the audience before I ask our panel our next set of questions? Okay. So we have a few minutes left. I'm going to ask you a really hard question, though, and I'm going to combine it. So what are you specifically planning for 2023? What are you doing within your business for 2023? And then a companion piece to that as you're going through this plan, what is it that's keeping you up at night? So I think we've rotated back to Jonathan, if you can start us off.
Sure. So I think in terms of 23, Matt, we've spent so much time the last few years, 3, 4, 5 years, focusing on the vision, the place where we're going, how we're going to get there. Now we're really in execution mode. All the operational pieces are in place. It's a matter of executing on the markets as the markets turn. And so all of our attention, we had a C-suite retreat a few weeks ago, and all the attention is focused on how do we execute on what we've been building for a few years' time, keeping the head down and focusing on the mission. I think in terms of the question of what keeps us up at night, not much other than, I mean, we've seen this massive shift in rates, which has been a very welcome sign for my business, which I'm not going to go into right now. But what we haven't seen is a shift back to normalcy in the consumer bankruptcy paradigm in this country. We're still at 60% down lows from where the numbers should be on an annualized basis. We own a business in the student loan space, in the mortgage space. All of that, I worry that I don't know if we're in a new paradigm where bankruptcy will not become the same type of opportunity or mechanism used by the consumer as it was in the past. I tend to think not, and I tend to think that we're going to see a shift back in that number upward as the student debt dynamic gets played out and rates continue to rise. But that's something we think about a lot.
Okay. Suzanne?
So just, I'll do two things. One is at the portfolio company levels, when we're looking, I mentioned margin compression. That is due to labor, increasing costs, how quickly we're going to adjust, with pricing, how, those are, these are all things that we have to consider for all of our portfolio companies. I would say the biggest challenge that we had in 22 was probably around labor. And I think that's that's kind of normalizing and I think alleviate itself a bit in 2023. And so in terms of plans, we're really focusing on strategy, taking advantage of a market where add-on acquisitions are going to bring our multiples down. And then continuing really for me is to continue to build. Good companies will continue to grow and provide exit opportunities for us.
I'm going to ask a question. Could you walk us through very quickly when the statement you just made of add-on acquisitions will bring the multiples down? And could you just elaborate on that a little bit? I don't understand it.
Yeah, so depending on the type of company, so we just acquired a golf supplies company at the end of last year. And it's one of the largest consumable supplies distribution company in the country. And it's a very fragmented industry, a lot of mom and pop owners. So there's nowhere to sell their businesses. They're either going to retire and the businesses go away because their millennial children do not want to take the business over. And, the multiple I would say we paid, which was very reasonable on the size of the company we did, we know we're not going to pay the same multiple for the add-on acquisitions that we did for the platform, what I would call, a platform company. And so over time, that multiple should be, down from the 7 times that we paid, probably down to like 5 on a basis so that we can get out.
Okay. And follow up, what's keeping you up at night?
I think it's always, for me, the number one thing as a CEO and a board chair, the thing I think about all the time are my executives and my team. And how, because every company, the C-suite, if they're not right, the company's not going to be right. And so I think that's what keeps me up the most, is really personnel issues, which is probably true for most executives.
All right, Jeff Caney, you got 1 minute.
I think I covered most of this. What's keeping me up at night is managing the extreme growth that we have ahead of us, managing that with not having a financial backer yet, and a very, very, very aging team, average age of our team, especially our machinist, average age is 58. And trying to find machinists, so automation, robots, that's what we're investing in now. So good things to keep me up at night, not running out of cash like it used to be.
All right, excellent. Well, everyone, thank you very, very much, and panel, thank you very much. This was fantastic.